You add 24 units, we basically doubled overnight in a building that needed a lot of attention. That sent me over the edge.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
Hello and welcome to episode 33. Today, I am very excited to be talking with Josh Sterling. And Josh is the owner of Epic Property Management, and he's also a real estate investor in both single-family, multifamily, and apartment communities. One of the reasons I'm excited to be talking to Josh is because I've listened to some of his interviews on other podcasts, and I can tell he's going to be a fantastic interview. The other reason is because he's from the other side of the state. So Josh, you own and manage properties in the southeast area of Michigan. Is that correct?
Yes.
All right. Well, first of all, welcome to the show.
Thank you. Thank you for having me.
Yeah, thanks for being here. Why don't you just start by telling us a little bit about yourself and the type of investing that you do?
We got into real estate back at really a great time in the market. I didn't realize it was at the actual time, but back in 2009, September of 2009, we purchased our first rental property. And to make a long story short, I'd always followed the predetermined path that everyone thinks they should be on. You know, go to college, do well in school, get a good job, buy your own property for yourself. And a few years into doing that, I realized that really wasn't the path I wanted to be on. So we got into rental property. It seemed like it made so much sense. It was one of the only businesses at the time I think I could really wrap my head around. It's pretty simple, right? You collect rent from your tenant, you pay for a property with that rent, and keep whatever's left over every month. So we did just that. We bought a single family property. My very first one was September of 2009, a quote unquote turnkey property. And I can get into that story, I'm sure, for you later, but that it did work pretty well, even though I made countless mistakes on it. And we started to morph the strategy into buying more and more single family, one by one. We got into realizing we could rehab those properties ourselves and still hang on to them and have a better property, better quality property at a better price. And that was where the strategy was born to what we do today. We're up to, as of tomorrow, we'll be at 160 units. So we've just been slow and steady making the march.
You said it was, your first foray into real estate investing was pretty simple, and you don't have to be a rocket scientist to do it. But you actually did go to school to be a rocket scientist, it looks like.
Well, no, I went to school to be an airline pilot is what I did. So
okay, so the aeronautic, a jet pilot. You don't have to be a jet pilot.
Aeronautical science was my major, and it seemed like a really great idea, and it was a cool job. It really was. Flying it's still one of my biggest passions. We have an airplane now that we keep and fly for ourselves. That it's the biggest joy out there for me. But I found that over time, it's a terrible industry, and I think anyone in that airline industry can vouch that that was really what kicked me into real estate was the instability of that industry. Forcing me to do something to provide for myself and what's going to be our new family here. We've got a new baby coming in 2 weeks. So getting married and having that family life start to develop, I just wanted something that I could count on myself, not on somebody else.
Well, let's talk about that first investment, because that's where it all started. And I kind of want to just go back to that time period. And I know you said that it made sense to you, but how did it even cross your radar, the idea of investing in a rental property? So
I had a regular job just like anyone else. And unfortunately, the industry I was in, it's very up and down. And so the airline I was with, I was flying as a captain, which is kind of the top position you can get there. And I was making okay money for the time. I thought I was doing great. The airline started having some financial trouble as the economy was starting to falter there back in the 2007, 2008 time. And they basically cut about half of our flying, which means that we only need half of the number of captains we have. So I got a pretty significant pay cut there. And that made me, that was obviously a huge financial hit. It was just a real gut check. I realized that I have done everything I'm supposed to do. I have done excellent at everything I'm supposed to do. Worked my tail off for the last 6-7 years, whatever it was at that point, to get this career going. And with one swipe of a pen, 3 weeks notice, I can get a 50% pay cut. So I thought that doesn't work. Real estate wise, I was generally just scouring. I mean, we had thought of all kinds of business ideas. I knew I needed to do something that I could provide for myself. So, I mean, I had an idea to do this valet trash service at this condo I was living in. I mean, I had some interesting business ideas. I used to keep just a running log of different entrepreneurial things that would come to mind. And for some reason, real estate just seemed the easiest. It seemed to me there was the least moving parts there. You literally, when I actually remember thinking when I was first getting into this about a podcast I heard, if you get 10 houses and each one of those houses pays you $1,000 a month, you check your mailbox every month and you get $10,000 in the mail. I didn't think about all the expenses involved, but in my mind, that just made sense. All you got to do is buy those houses and $10,000 a month comes in. Well, how easy is that? As you know, and I know now, there's a lot more moving parts than just that, but the simplicity of it made so much sense. Your tenants will pay those mortgages for you. You know, there's cash flow at the end of the day. So that's how the light bulb just went off. It seemed like something we could do without too much effort here, without too much knowledge and extra skill, right? Anybody can go sign a piece of paper and now own a house. And then the first property we bought, I'll get into it real quick. I mean, I really did not know much about real estate at all. I owned one property that was my primary residence, and it was very far upside down from the housing market crash that had just taken place. So didn't know much about buying houses, but we found a place. We were looking for something that was turnkey, that I didn't know how to do any work either on these. I'd been an airline pilot, not a contractor. So we found a place in Southeast Michigan that was kind of turnkey. It looked good. It was definitely you could move someone into it. And
are you talking about, was it a single family house?
Single family house, and it was September 2009. We closed on it. It was $40,000, and it was I think we moved someone in the next day. I mean, it was turnkey basically. It was, now that I look back, it wasn't nearly what we like to do on our remodels now, but I didn't know at the time. So we moved somebody in, and that was the key for me, because I couldn't get my head around what it would take to rehab a property and all the investment that takes, where that money comes from to rehab a property. I knew that I could get that first property, move somebody in, and start getting rent coming in every month. And that was what we did, and it worked. And it's almost good that I didn't know what I didn't know. Because there was a lot of things wrong with that deal, and it still works. I actually still have the same tenant in that house today, as a matter of fact.
Wow. So you paid $40,000 for a single family house.
Yes.
What kind of rent were you getting?
We rented it for $800 a month for a 3-bedroom house.
Wow. And and you're saying you didn't do any rehab. It was turnkey. So you put no money into it.
Yep. I think we might have put $50 into like doing some caulking. I mean, it was, and I went out myself and did it. We literally just moved someone in. Didn't have, I didn't know anything about getting appliances set up, about getting any of this stuff. In fact, the lady, I tell this story all the time. But the woman calls up, and since I'm not from Michigan, I didn't really know. She goes, Does the property have central air? And I said, I don't know. What's that? I didn't know anything about real estate. There was the most ironic part, looking back now, there was a big sign in the window that said for sale on land contract. And I told my wife, I go, I don't know. That sounds like a scam. We should just pay cash for this, because we scrimped and saved all this cash. So I could have leveraged into the first deal too. But again, I didn't know. There was so many things that I didn't know. Wow.
So you just went in almost completely blind.
It was so blind. And you've heard the saying, you don't know what you don't know, right? And there was so much that I didn't know then that I didn't even know what to be afraid of. So it was actually kind of a blessing. And I know we talked a little bit before this, but I didn't know there was any RIA groups out there. I don't even know if there were podcasts, actually. If there were, I weren't listening to them. I didn't really have any kind of coaching or mentoring, which is scary because of the mistakes that I could have made, but it's also encouraging because I didn't get that analysis paralysis, because you're not scared of something you don't know is there.
Well, yeah, and that fear factor is very important, because in 2009, everyone was scared. And the reason you could buy these properties for so cheap was because no one else was out there buying them. Everyone felt like real estate was just going to keep plummeting.
Right. Right, exactly.
So maybe you're right. I mean, what you didn't know really came into your favor because you didn't have that fear.
And another thing that's out there that was really working for me at the time, it sounds like a negative. I just received a 50% pay cut at my job. I was really in a bad financial spot. I had a bunch of student loan debt. I had a majorly upside down single condo that was my own. I was really looking bad, but I was actually in a spot where I felt like I had nothing to lose. I felt like I've done what I'm supposed to do in life to get to this point. It hasn't worked out, so I'm going to try something else. And it was almost, for lack of a better way to put it, it was almost like that rock bottom. Just try something. And had I been a little more established, like I see, some people today, they've got a good job, they've got a good family life, they're putting some money in the bank. It's actually maybe sometimes a touch harder to just kind of risk it. So in a way, it was a positive, the timing that this hit for me too.
Yeah, definitely. Let's look at the numbers here. So you paid $40,000 cash for this house. You were making $800 a month. What kind of cash flow were you making after taxes, insurance, all that? So
we paid $40,000 cash. For simplicity, we can call it cash. It was really a hodgepodge of 0% credit cards, money we'd saved up, a tax return. But all in all, there wasn't a mortgage on the property. But we did use some pretty creative financing because I really didn't have the $40,000 cash at the time. So the cash flow there was an $800 rent at the time. It was, again, probably below market. I just didn't really know. Taxes were about $150 a month. At the time, I don't even think I budgeted for maintenance or for vacancy or anything, but we had insurance, and at the time, that was probably about $80 or so a month. And then we had essentially that everything else being, in my mind, cash flow. I didn't think about management, vacancy, maintenance, anything like that. In reality, there are a couple other expenses, as I'm sure you know and your listeners know, that you need to factor in there. So now we budget in there a management fee. We run flat fee management at $79 a month with our company. So we budget $79 a month management in. We budget about $50 per property per month for insurance, which is lower than I could have got it with one or two houses. Once you get some more properties, you start to see some volume savings there. And then we like to budget 10% for maintenance, which some people might say is kind of high, especially on a fully rehabbed property. But what ends up happening is the CapEx creeps in there, the roofs, the siding, and whatnot. So it does reduce that cash flow quite a bit when you actually factor in all the things that are really going to happen. But it's better to look at a true picture of it.
Yeah, absolutely. So, yeah, it sounds like you were making some decent cash flow right out of the gate. This was 2009, which when we all look back, we know was right at the bottom of the market. So it was the perfect time to buy. And I want to talk about the next deal you did, because before the show we were talking about going from 0 rentals up to 140 or 100. You're almost to 160 as of tomorrow, right?
Tomorrow, yep, we're going to close on a package of 8 tomorrow. That's been in the works for 7 months now, but it's we got a closing date and time, so that's pretty much set.
Before the show we were talking about the just that trajectory. How do you get to the next level? And you already got your foot in the door. You had a rental property. How did you take that next step?
Well, the first thing that I realized as we got that tenant in that property and it started producing cash flow was, okay, for one, this isn't that hard. I was learning a lot, but it wasn't that hard. But where I realized the first problem I saw was that we were looking for this turnkey property. For one, those were getting snatched up left and right because I was competing with every other homeowner that wanted to buy a house as well. So they were getting snatched up, they were getting bid up. It was, there was a high demand for those turnkey properties. For two, I pretty quickly realized that what I thought was a turnkey property was pretty much a lipstick on a pig remodel. And that just seemed like an opportunity for me. I thought if I can remodel this myself, I looked at the tax records, and the house that I bought for 40, the person who sold it to me had actually flipped it and bought it for 13, and we're not in a slummy area or anything. It's just, this is how bad the market was. This guy had bought a non-performing note, and for $13,000 had bought this property, put probably $5,000-6,000 into it, and sold it to me for 40. And I thought, why don't I do that? buy the cheaper house, put the remodel in, control the finishes that I want, and then I'll have a higher quality property. It'll probably be worth more, and I won't be into it for as much money. So that was the next step. Okay. And that's what we did. About 6 months later, we found a property that was just that, not too far away from the first. Unfortunately, I didn't know anything about remodeling, so I did have a resource in my father who from California had done this, and he went ahead and moved out for a month. We spent a month virtually living in the house 24/7 doing this remodel ourselves. It was a big learning experience, but we got it done. And that was what propelled us to what we're doing today, because it was true. It was almost like we'd flipped that house to ourselves.
I know you're in Southeast Michigan. What
Yes.
neighborhoods or areas were you actually buying in so far?
So we're in a market, if you're over in this area, you'll hear it referred to as downriver. And it's the cities of Southgate, Wyandotte, Trenton, Woodhaven, maybe up to as far north as Lincoln Park. I specifically stay out of any of the areas right around the city of Detroit, or the Inksters, the Melvindells, that people in this area know what I'm talking about here. Those are, you literally can buy houses for, at the time, probably hundreds of dollars. Even today, probably a few $1,000s. We're in a market that I would call a blue collar, or probably a C plus market if you refer to it that way, maybe a B minus in certain cities. It's your average price today, to give your listeners an idea here, your average price of a fully rehabbed and ARV, if you will, on a home is about $120,000 to $130,000 for our average property. So we're in that kind of middle tier market.
The Rental Property Owner and Real Estate Investor Podcast is brought to you by the Rental Property Owner Association, providing services and benefits to Michigan investors for over 48 years. The RPOA benefits and services include investor networking, property management and investment forums, tenant screening services, free limited legal advice, education, national and local discounts, and lobbying for the industry. Receive a 50% discount on your first-time membership with the RPOA by calling 616-454-3385 Monday through Friday and mention this podcast. Once again, that's 616-454-3385. The RPOA, where over 1,300 Michigan landlords and real estate investors go for success.
And let's talk about the second deal that you bought. You
Yes.
bought basically a property, a single family that needed some rehab, right?
So yeah, now we were not looking for that turnkey anymore, which was great because there was a lot of inventory at the time. I think this time we're into maybe March of 2010, I think it was. So there's inventory all over the place. You could basically just blindfold pick one off the MLS and be okay. And we found one that needed work, that we liked the overall structure of the house. It needed what we thought was, some cosmetic work, some flooring, paint, carpet, doors, cabinets, things like that. And we went in and we bought that house for $28,000. It was a 4-bedroom house, garage, basement, just your standard. There are a lot of very similar properties in this market here. The entire downriver area, it basically looks like was built between 1948 and 1952. They just went up like wildfire. So they're all the same house.
Okay, so post World War II housing.
Yes, just a booming area at the time, I'm sure. So we went into that property for $28,000, and because my dad did the work basically for me for free and I helped him, we ended up getting the property rehab for about $9,000, which was, looking back now, I can't come anywhere close to that with the cost that we have in rehabbing. But at the time, so I was into that property for about maybe $37,000. We rented it for $975 right off the bat. So instantly I was into the property for less. I rented it for more because it was a better rehab and it was a little bit bigger house too. But I was into it for less. I rented it for more and I had a better quality rehab. And the kicker was that house was probably worth 60 or 65 even at the time, right? So I had basically added that value. I'd forced that value in. I could have flipped that house. I could have turned on and sold that and probably sold it for 60, 65 at the time. So it was just a win in every different direction. And that was, as soon as we did that, that's when things started to really, my eyes started to open up to what the opportunity was on the value add side.
Yeah. Now you say you could have flipped it, made the money. You chose to buy and hold. What is that property worth today?
It's probably worth 95 or 100. I try to conservatively value all these things. So, if you ever had to sell it, you'd have realtor costs and whatnot. So we'd probably net 95 or 100 on it. And I'm glad we held it, but I'm a big proponent of holding for cash flow. We flip a few properties here and there, to keep contractors working or to generate a quick little influx of cash. But by and large, I'm a cash flow investor. If you flip a house, for one, it's way harder. There's a day of reckoning, right? The day you sell, you either made money or you lost money, and that's hard. Flipping is a lot tougher. But there's the day of reckoning, right? The only way you're really making money is if you force value into that house. If you buy and hold for cash flow, you're going to make money with cash flow. You're going to potentially have appreciation, either forced like I did in that case, or market appreciation over time. I'm not saying that anyone count on market appreciation, but it tends to happen over a long period of time, but definitely forced appreciation. So you have cash flow, appreciation. Your income is going to be virtually tax-free or very, very reduced tax-wise with the depreciation on the property, right? My ultimate favorite is you're going to pay down the principal. You're going to put debt on that property over time, and you're going to let your tenant pay that principal payment. And even if that's only $200 a month, a lot of times your cash flow might be $200 a month. So you're basically doubling the return. You're just putting it in your secret. I always call it my secret equity bank account, because it's there, it's return, and it's there for you later to use, but it's just held in equity in the property. So then you're also, I love putting financing and leverage on property because you let inflation destroy the value of the dollar, right? Which is an old Jason Hartman thing. I stole it from him. I use it all the time. But so it's so much. It's so much easier in my mind to have a buy and hold cash flow rental property than it is to flip a property where you're going to get taxed terrible. You're looking at sometimes 35-40% of your profit in taxes right then and there. If you're wrong at all, or if you get a bad appraisal, anything goes wrong, you don't really have a lot of options to make money. And then the day you sell it, you've got to start over and do it again.
Yeah, you got to keep that machine working.
So.
Well, since you brought up financing, have you bought the second property with cash, right?
Yes. Again, I couldn't get a bank loan at the time. For one, lending was extremely tight. If you remember back in 2010, I mean, the banks were running for the hills.
Cash was king.
Exactly. So I didn't have a lot of cash, but I definitely couldn't get finance for anything. The one thing I did have going for me was I always had good credit. I've never not paid anyone a dime. And so that was probably the saving grace. But we got creative again. We were using 0% credit cards. We were using lending club loans. We were using personal lines of credit, whatever we could do to pull cash together. And luckily, the more beat up of a house we were looking for, the cheaper they were to buy. So it was a lot easier to come up with a $25,000 or $30,000 purchase price than it would be to come up with a $70,000 or $60,000 purchase price if I wanted that same house turnkey.
Sure. What have you done in the meantime? Have you gone back and put financing on the property? Done a cash out refi?
So yeah, it's I think I fell backwards into this strategy, but it's one that we do to this day. I just closed a note last week in this. What we did was after we had, I think it was 6, maybe 7 properties. On paper, they were all owned free and clear, right? I had accrued a bunch of what looked like consumer debt to try to, buy and rehab these properties. But on paper, it looked like they were free and clear. I think we might have had one on land contract. And so I knew that there ought to be a way I could pull money out of these properties. I first started just like anybody would with the one at a time method. Go to Chase or Bank of America and ask for a mortgage, which due to my income at the time and my student loan debt load and whatnot, I could not get approved for one. So I started calling around a bunch of portfolio lenders is what they're called. Basically banks that write a loan but don't write conforming loans. They write loans that they keep on their own books in their own portfolio. Once we found that there was a bank that would do that, I called quite a few of them. Didn't know exactly what I was asking for. Just kind of didn't even know what I really wanted. But I got a small credit union, real small, 5 branches, which I found is pretty much the best. If you have one guy who is the leader or is the entire commercial lending department, if it's a one-person show, that's the bank you want to talk to, because that guy can actually make a decision and make something happen. right?
You don't have to wait a month for the committee to get together. And
right.
make a
So
decision.
I called this bank and I said, I've got, these properties. We don't have any mortgages on, I think, I don't know, 6 of them or whatever it was. And I want to be able to pull out a mortgage on each one of these to get some more capital so I can buy some more property here. This is we're into 2011, I should say, probably early or mid 2011 at this point. So this lender that I talked to, this one-man show at this small credit union says, well, we'll just package them all together for you and give you a loan for $100,000 was our first loan. We're going to package 4 of these together. He said, just tell me what your purchase price. It was based on my purchase price plus how much I had in the rehab, and then they loaned me 75% of that. So pretty smart on their part because there'd obviously been some forced appreciation, but it worked out too. They were going to loan me $100,000 on 4 houses, and they packaged them together, and they did just that. And I walked out of closing with a check for $100,000 at 4.5%. At the time, it was probably 5.5%. Rates were a touch higher then, but 5.5% interest, $100,000. That was the best. That was the cheapest money I'd ever been able to come by since we started.
And did that allow you to pay off that consumer debt you'd racked up?
We did a little hybrid method on that. I didn't want to just go wipe out all the consumer debt that I had accrued, which luckily wasn't $100,000. It was, I don't know, maybe in the 40 or so range. But I had been chipping away at that anyways. We were living extremely cheaply at the time. I was driving like this, mid 90s Honda Accord. I was, living with my wife's mom when I moved to Michigan. I mean, it wasn't glorious by any means, but we were living cheap. So we were chipping away at the consumer debt we'd racked up to accrue these properties. We paid off a little bit of the stuff that really didn't make sense, and then we still had a bunch of money to work with. And that's what let us go out and buy more properties, which got us on this model that we've still been on to this day, where it's just a rent and repeat off of that.
Okay. The thought occurs to me, the last couple interviews I've done have been with people who've done house hacking, where they bought a duplex, lived in one side, rented out the other side. Did you and your wife ever consider doing something like that?
At the time, I think of course, the airline industry I was in is so unstable and so hectic that I got transferred all over the country, from Memphis to Detroit to Minneapolis to Chicago. So I never really I could never really purchase a home that I would live in. I had a place in Florida that she ended up moving to go to nursing school, and I got transferred. So it just never worked for us at the point in our careers we were at, but it seems like a great idea. If I was starting out today, I would most certainly do that. Buy a house to live in and let some of your friends pay down some of that mortgage for you.
Yeah. But you seem to have found something that was working for you. You had 2 single families under your belt. What was the next step? Where'd you go next?
So the next step was basically the same model. We wanted to rent and repeat that. Now we knew that, okay, if we go and buy a property that needs work, I can figure out how to do the cosmetic work. I can hire guys to do that. I started to learn a little bit about rehabbing, right? We can get those so much cheaper. So we went out and we bought smaller properties. I didn't have really the funds, so I was trying to get into this property as little as possible. And then at the time, since things were so tight, I knew that I could rehab it on a Lowe's credit card and slowly make payments on it. Again,
you were still doing this with your own funds and with your own credit.
Whatever we can scrape together, right? Mm-hmm. At this point, up to about 4, and then we did borrow a little bit of money from my wife's mom. Once she saw it working, she did lend us a little bit after, I think, for number 5, we got a little bit of private investment, or maybe it was number 6. But it took. Nobody wants to loan you money for your first house because everyone thinks it's, for one, that real estate's a terrible investment at the time, and it was going to go to 0, as you mentioned, or they think that we don't know what we're doing and a tenant is not going to pay rent and whatnot. So it took a few to get going. But the next 2, we just bought even cheaper houses. For the next one, we paid $20,000 for this little 2-bedroom house, which is a great little cash flowing house right now. And we did the same thing. We put about $10,000 and $12,000 in the remodel. I'd hired a little bit of labor on that one, and then the next one after that, we paid $23,500, I think it was now. Same thing, and we did a little bit of rehab and got those rented, and that's when I started to kind of morph my strategy a little bit in terms of not only do I want to rehab these myself, or with our crews, but I want to rehab these above market. So the more and more rehabbing we started doing, I started to realize that the nicer the property you make, the better quality tenant you get, and then the more consistent cash flow you get. So just because somebody will move into your property doesn't mean that cash flow is a guarantee, as any rental property owner knows here. But if you can get a higher quality tenant to move in, then that cash flow is more steady, more guaranteed. If you can give someone a reason not to move, then that cash flow is even better, because turnover is just such an expense. Even if they haven't done anything to the house to cause damage, there's still going to be smudged paint, cleaning, time to lease a new property to a new tenant. So we started to go for that model. We started to go for
talk about that. What did you do differently in order to attract that better quality tenant?
So now we started realizing that what that better quality tenant wanted was best product, best price, right? Which makes sense. And so we wanted the best product, which would be the best quality house we could put together. So we started doing higher end remodels, and I had people all over the place at that point. Maybe what do we have, 4 or 5 properties? I had everyone I talked to would tell me that I was crazy for putting stainless appliances and granite countertops in these rentals. But as we started doing that, we started attracting these higher quality tenants that had either good credit or good income, and just wanted to rent a place because they didn't want to be tied to a mortgage. They were afraid that the house prices were going to continue to go down for whatever reason. There was very good quality tenants out there. They wanted to rent. And so we just started to do that nicer quality rehab, best product. We also started to focus on, although it was just myself and my wife would help out a little bit at the time, trying to set the base for that professional property management in there. And even though we were tiny, we kind of tried to fake it till we make it, try to sound like we were a little bit bigger company, and tried to always just be absolutely professional with everything we did, with our documents. We always tried to feel like we were bigger than we were, so that we could have that professional feel. And I think that helps. So best product there, and then best price. We would just try to rent these properties at market rent. Let's say that house we rented for $975, we might have been able to get $1,100, but I felt that would give the tenant an incentive to maybe move down the road. So if they have the best possible property on the market and it's at a very fair price, then they're not going to look for another place to rent, and that's going to save me money over time.
Saves you a lot of money in turnover. How has that proven out? I mean, have you had a lot of long-term tenants?
Absolutely. I think that's a really, really tough metric to track, but I can go back and look through our initial rent rolls, and we do have turnover from time to time. It's going to happen. But going back to look through our initial rent rolls, there's, for example, my very first house happens to have the same tenant. My second house has the same tenant we initially put in there 5 and 6 years ago. So when you start seeing metrics like that, we're talking 7-year tenants here. Those are good signs. I feel that we have much less turnover than other colleagues I know in the business, and I think that's the reason for it. So we've actually expanded on that strategy, and our remodels are, I mentioned the first remodel cost me somewhere around $8,000 or $9,000, somewhere in there. I think it was about $9,000. Our remodels now cost me $20,000, $22,000, $25,000. We're putting granite in every single one, stainless appliances, all refinished hardwood floors, 6-panel doors, 3-tone paints, light fixtures, tiled shower surrounds, tiled backsplashes. So we're targeting that higher end rental because of what it does for the management side of things and eventually the cash flow side of things when you limit that turnover.
And let's talk about the management side of things, because it sounds like at this period, your initial single family homes, you and your wife were doing the managing.
Right.
And I would imagine that when you started, you had no idea what you were doing.
That would be accurate.
So how did you get started doing it correctly? What resources did you call upon, and what kind of lessons did you learn along the way?
So we started, the first thing you need is a lease. So we started with a template lease online. We muddled through the mistakes. We found an application. I remember not even myself understanding the process from what if you get 2 or 3 different applications on a house, and we've had 6, 7 rentals, and we'd get 2 or 3 applications on a house, and I didn't know how to process them, what to do with them, how to screen them. And we're supposed to have an idea what we're doing here. We're supposed to be the landlords. I don't even know how to process these. So we really just muddled through this stuff. We just, if a problem came up, we Google it. We talk to a friend that, maybe I had a friend that had about 20 rentals at the time. He still has about 20 rentals. Great guy, but he had a little experience. He just isn't growing this business above that, I've realized now, and that's a whole nother thing we can talk about Plateaus. But I'd talk to people that had a few more units than I had, that I had finally started to meet through some of these RIA groups I started to get into. And from there, we came up with the strategies we felt worked for us.
Okay. Did you ever call upon the resources that the RIA or the Rental Property Owner Association have?
I found a local RIA, about 6 or 7, somewhere in there, a few properties in, I found a local RIA, and that was nice. That actually was one of the more encouraging things once I started attending this RIA, and now I attend numerous RIAs in the area and listen to numerous podcasts. Once I started finding the education that was out there, that for one, other people do this and they're successful, that's encouraging, right? You can kind of join the herd a little bit. And then for two, to know that if you have a question, somebody else has probably had that problem somewhere else, and they'll give you their opinion or the way that they dealt with it. So once I started doing that, that was nice. That really helped us to kind of settle into it, which helped us to then, grow and buy more properties, which is the goal here, right?
Yeah, absolutely. And personally, if I was managing my own properties, I would probably wake up in the middle of the night screaming with horrible nightmares. What can you tell me any stories from that period of managing your own properties? Did you have any nightmare type scenarios or problems that you remember?
Probably there was a lot of luck involved with my entire progression into real estate. The timing of it, and one of the things that was lucky was I didn't have anything just terrible happen. If you tell people you invest in rental properties, you're going to get usually a couple stereotypical responses that the tenants are going to destroy your house, that they're going to not pay rent. I remember my big fear was that I'm going to list this house for rent and it's going to sit vacant for months while we try to find someone to rent it. That was a big fear of mine. You're going to get calls at 2 a.m. that the toilet is overflowing and all these things. None of those were actually happening, which was nice. And I think if you actually poll landlords that have well-maintained properties and actually do this right, that you're going to find that is not what happens with rental properties. So I'd love to say we just had these terrible stories, and I can tell you these, down in the trenches, terrible things, but it really wasn't that bad, which was really good, because maybe it was luck. Maybe we didn't have any problems right up front that were major. We might have had a tenant or two that was late on rent. I can actually recall when I was self-managing, we had a tenant that was just chronically late on rent, probably because I didn't screen him on the way in because I didn't know what screening was. So I guess I can blame myself. But that was a big stressor for me. I would wake up at 3 a.m, and if I have 5 units and one guy doesn't pay rent, that's 20% of my income for the month. Imagine if that happened at your job. So that was stressful. But really, it's not. The stereotypical problems, I don't think, are there, especially if you do it right. If you're not a slumlord, if you're out there putting nice remodels on, you have professional management, you treat the tenants the way you want to be treated. My rentals are identical finishes to my own house that I live in, even to this day. And you get good quality people that need and want to live in these properties and are going to take care of them, are going to pay rent on time, and actually be the investment that it should be for you.
Let's talk about screening tenants, because it sounds like in the beginning you didn't understand what kind of screening you needed to do, and it sounds like you weren't doing it at all.
Right. So we started, and I knew that there were some online options for running credit and for running background checks and whatnot. I didn't actually know you could check for evictions for probably the first 20 units that I had. But we were barely screening. We would, if we thought that there was a red flag with somebody, but we weren't sure, we would go onto one of the online sites, and there's a bunch out there, Mr. Landlord sites, and there was one called Tenant Verification Services we use, and we'd go onto sites like that, and we'd run credit sporadically, but there was zero consistency in that. We were basically just running it if we had a gut suspicion. And anytime you start using your gut in this business, you've already made a mistake. When it comes to tenant screening, right? You have people that you can't let someone move into your rental property because you like them and they don't have a job, and you feel bad for them, right? So we initially weren't doing much at all. We got a little bit more consistent as time grew with it, and we started to screen. I actually, maybe it was the cheapskate in me, when we first started, but I would screen one of the applicants and not the other. I said, all right, if the husband checks out, then we won't screen the wife, and silly stuff like that. And I don't know where that logic came from, other than I just didn't want to pay the $30 it cost to screen someone. We didn't charge an app fee at the time, and so we thought, it was all out of pocket. We've since morphed, obviously, to a much more logical and professional viewpoint on that. And every person over 18 goes on the application. They go on the lease. We take an app fee from every person, and we screen every person. And it is you find so many things that I didn't know were lurking before this.
But it sounds like you dodged a number of bullets there, because
I did. That's
weren't
what it was
screening, but
yes.
You still had good tenants.
And we found some pretty good tenants up front, and the problems that we had, I think I mentioned earlier, we had a tenant that was chronically late paying, and he was probably there for a year, and worst thing is we probably ended up being behind maybe 2 or 3 weeks on rent when he left. One thing that actually, to touch on that, back when I first started doing this, one thing that is a stereotype that scares a lot of new investors is the eviction process. What if somebody doesn't pay you? Doesn't it take 6 months to get them out? I'm sure you've heard that. Mm-hmm. One of the best things I did was I actually just sat down and learned that every state is going to have its own different quirks, but it's generally the same idea. But I just sat down and learned for the state of Michigan what that eviction process is. So I fully understood what happened from the day a tenant didn't pay you rent to the 7-day notice going out to the complaint going out and getting a court date and whatnot. Once I understood that process, then I wasn't scared of it anymore. And then as soon as a tenant became late, we would send them the 7-day notice, which is the non-payment of rent form from Michigan, and get that ball rolling that we could evict them if we wanted to. So that was a big stress reliever too, to kind of go back and circle back to that, is understanding and learning what the process is so that you're not afraid of it when someone doesn't pay rent. That's how you avoid that situation that everyone's heard, the landlord that's 3 and 4 months behind on rent. To me, that just boggles my mind now, because one of our tenants, if someone was late, they're going to be out of that property in 45 days if they take it all the way through the court process. And usually it's less than that.
Yeah, that's a good point. I mean, if you're a landlord and you have a tenant that's 3 or 4 months late on rent, then you should hire a professional management company.
Absolutely.
You can save yourself a lot of money by having a professional management company managing your property. So you mentioned Plateaus, and you reach a point in your investing where, like, maybe you just stop for whatever reason, but you didn't stop. How many of these single families did you buy using this initial model?
Well, we actually still use that model to this day, but I find I mentioned a friend of mine that has about 20 or so units. That when I first started, this guy was, he was just the ultimate investor here. I just thought this guy knew everything, and he's a great guy. He does a great job, but he'll probably never get above 20 rentals. That was a plateau for him, right? Now looking back, I see what's happening to him, and what I think happens to a lot of people. And I started to kind of realize there's plateaus probably in everything you do, but definitely in starting to grow your rental portfolio. And the first one is getting off the ground. I mean, the first one is buying your first rental. And there's maybe half the people you talk to on an average basis here, maybe half the people that you talk to that want to get into rental property investing are never going to get off the ground, or the first plateau, if you will, right? They don't take the plunge. Once they actually do, you find a lot of people that'll get out there and buy 1 or maybe 2 houses, and they don't they reach another a plateau. It's almost like you're at step 2 and they're not going to climb to the top of the flight of steps here. They stop, and I think that plateau starts to have to do with financing. Most of the plateaus, I think, up front that we encountered had to do with money. Then it morphs into some other things here, but they don't know where to get the money for the next down payment. They don't know where to get the money for, the rehab that they need to do on the property, or they don't know where to get the next mortgage or whatever. So I found that was a plateau that, people need to overcome. They're into the game. They've got a rental or 2 or maybe 3, but they have a hard time moving over that. And then you see that next tier of investors here, and they get to maybe 10 or so properties, and 10 is kind of a magic number because that's pretty much the largest number of conforming loans you can get. once you hit 10, you're virtually capped on the conforming loan side. So I know a couple of investors that they got 10 mortgages in their name. They were able to put down payments on all those properties, and they're basically stuck because they don't know how else to finance the next property. Again, it's a money thing. Money is the limiting factor here that's putting a ceiling on what you can do. The next plateau is you find a way to break through that. You find either some private money, some portfolio money, a credit union that'll work with you beyond that 10 loan limit. And you start to get to this plateau of maybe around 20 properties. I know a lot of people that get stuck about 20, 25 units, somewhere in there. And that is, again, it's another money issue. You don't have the means to put the down payment on that next property, or at this point, you're probably having to buy them cash. You don't have the means to do that. You don't have the means to go in and rehab that, but you're also starting to get into a new realm, which I think a lot of people experience here, is that you're probably still self-managing with 20 units, right? If you haven't taken the leap to go with a management company right off the bat, when you get to 20, 25 units and you're self-managing, you've now just created yourself a job. And everyone that I talk to in this realm says the same thing. They go, oh, it's not that bad. We only have a couple phone calls, a week. There's some weeks that are worse than others. If you really look at it, it's much, much worse than that. There's always something wrong. It's just something wrong is different all the time. So that's where you start to transition. I think you're at a plateau because you're having a little bit of trouble finding money, but you're really at a plateau. You can't grow because you don't have a way to manage these effectively. And so we had a little struggle there. We were at about 20 some odd houses, and we added a 24 unit apartment building at that time, which came to us. It was a good deal. It just needed a lot of work. It was 42% occupancy. It was kind of a mess. That kicked me over the edge. That was I didn't have anyone managing for me. I had no one working for me. It was myself, and my wife would help out when she could with showings and whatnot. But you add 24 units, we basically doubled overnight in a building that needed a lot of attention. That sent me over the edge. And what that caused me to do was hire an assistant, or we called her an office manager right off the bat. She basically started handling phones and showings and lease signings and all that. And that's how we got above that next plateau. And then I've started to find that the plateaus from that point on, from once you get above that 25 unit, it's almost always a management or a systems related plateau. And even to this day, we hit different levels where we've had to add new employees. We're up to 7 people in the office now to manage our units, and the units we manage are about 65 units right now for other investors. We just really started doing this year. So that's kind of there's these different levels of it. It starts with money. It becomes management, and it becomes more people and systems issues that you start to have as you start to grow.
Wow, you just said a lot of things there that I want to kind of go back and talk about, because I agree with a lot of what you said, and you brought up some things that I'd never really thought about. Starting with those plateaus, and the fact that the reason some people reach a plateau and never exceed that plateau has to do with money.
Right.
Because I know, and you did the same thing when we both started. We were using our own money and our own credit to buy the properties.
Right.
And that's a lot easier because it's our risk. We're not risking other people's money, which is a vastly scarier thing.
Yes.
And you reach a point where you run out of money, and you have to, if you're going to progress, you need to start using other people's money.
Right.
But there's a psychological barrier there for a lot of people to using other people's money. And that could be a showstopper for a lot of people. And in fact, you and I both know people who are stuck in that place.
Exactly. And once you get over 20 or so units, like you said, money becomes not as much of an issue anymore, because you have had to find a way to use other people's money. The easiest way to put it is, if you want to buy a $10 million apartment building, you're going to need $2.5 million down payment on that, right? How many people, even wealthy people, do you know that have $2.5 million liquid? So you're going to be using other people's money if you want to grow this to a large scale business.
Absolutely. And you reach a point, and there's another component to that, because a lot of investors, and especially people who manage their own properties, tend to be very much do-it-yourself type of people. So the idea of having a partner or bringing other people into the investment is just, that's something they can't, they would never put up with. They just can't comprehend how that fits into their model of doing things. But, and this is interesting because it's, I'm speaking for myself here now. I reached a point where once I ran out of money, I went to friends and family. And that was a little bit easier because it's friends and family, and they trusted me to manage their money in these investments. But then you reach a point where you're right. You get into these $1 million, deals where you need to raise $1 million, $2 million. You're not going to have enough friends and family to do those types of deals.
Right.
Then the sales component has to kick in, which is an entirely different skill. The sales part. And you own your own business and your own management company, and you're up to 160 units now. So you must have encountered this too, but you now have to start not just convincing yourself or proving to yourself that this is a good investment to get into, but you have to figure out the best way to convince other people that they should risk their money in this investment as well and go along with you for the ride. And there's a huge sales component to that, which is an entirely different learning curve. Have you experienced that?
Yes, absolutely. And for me, what it was getting over the fact that you're asking people for money. I think coming from not a lot of money growing up, to me, that was always a fear that I didn't want to ever ask people for money. That didn't seem right to me. But what I realized and what helped me get through that was I'm actually offering an awesome opportunity to these other investors. And there are so many people out there that have money that aren't making a good return on it. And it's not a secure return. Maybe it's in the stock market. Maybe it's in cash sitting in a checking account. So for me, what happened is I realized that I could actually provide an opportunity for other people, a secured investment that they were going to get paid every month and they were going to do as well or better than I promised them. And once I started doing that and I started seeing that they could actually benefit, I didn't feel like I was asking for money anymore. I felt like I was now bringing them in as a partner basically on the deal, whether it be just debt financing or equity financing or however we wanted to approach that. But that once I realized I was providing an opportunity, that was that took the block away from me.
Yeah, because it's a scary thing to approach someone and say, "Hey, I've got this investment. Do you want to go in on it with me?"
Right.
And but when you realize the benefit that you're providing to that other person.
And I think for me, where it started to hit home was once I had done that once or twice, and it wasn't necessarily family, or maybe it was a friend, but a distant friend that wasn't real close, and they invested with us, and they did well when it was all said and done. Maybe that'd be a short-term rehab, or where we refinance them out or whatever. But once they referred me out to someone else, then that's where the referral is like the greatest compliment, right? So that's where I started to realize that we are providing an opportunity for the investors that want to work with us. And so I can win because I can do what I want to do. The investor can win because they can make the money they want to make without having to go out in the field and take all the lumps that we've taken to get to the experience level we're at. So it's a win-win situation. So it made it much easier for me to start to pitch that, if you will, or really just talk to people and tell them about the opportunity we can provide.
Yeah. Now, are you are you still in the partner phase where you're bringing in individual partners for joint ventures, or have you started syndicating yet?
So we've worked on a couple syndication deals. Especially when it comes to other people's money, I am so conservative with it. I probably passed on a lot of good deals because I just wasn't 100% sure that, like my multifamilies that I own right now are such slam dunk deals that we bought. We probably had to look at 100, 150 deals to get each one of those. So when it comes to the syndication side of things, as inflated as I've found the multifamily market yet to be recently, we haven't done any large syndication deals yet. I've got a small 12-unit deal that I did a little bit of an equity split with that worked out well, but I do have a couple actually in the works right now. So I have two different deals that I'm working right now that both the numbers finally make enough sense for me that I can justify using other people's money on those. What we do a lot of though is single family. I mentioned how we consider the properties we do, we're flipping to ourselves, right? We're rehabbing them and then adding value and then refinancing those lenders out. So what we'll do is we'll go in and put private money on a property. Usually that private lender will fund purchase and sometimes purchase plus rehab. We'll pay a pretty good rate for that, 10, 12%, somewhere in there. And then we'll refinance that private lender out in usually 6 to 8 months. It's no different than if we flip the property, but our number one strategy, our plan A, is to package 5, 6, 7 of those together at a time. Refinance them all with a portfolio blanket loan like we do. And then at closing, all of the lenders get paid off, get their capital plus their interest return back, and we keep the properties. And what I've found is the lenders don't necessarily care who pays them off, whether it be the credit union that refinanced us or whether we sold the property or whatever. And so they're happy. And then it lets me work with my strategy to acquire cash flowing properties instead of just flip everything.
Yeah, great way to go. Great way. I want to go back because you kind of jumped from the single families that you were buying. You got up to a certain point, and then you bought a 24 unit?
Yes.
So talk about how many single families did you get to before you made that leap?
I think we had 22 or 24, somewhere in there. It was the
all
low
single
20s.
Families.
All single families.
Okay.
One was maybe a duplex, but yeah, essentially all single family houses.
And then like that, you doubled your portfolio.
Yeah, so the deal just came about. It had been, like I found with a lot of multifamily deals, it had been something we'd looked at probably a year and a half, 2 years prior, and it came back to us. And we ended up finding a seller who was in a bad situation that just needed out of a building. He had gotten it on I call it the downward spiral. He had, started having tenants move out, so he had less money to put into the property. So then he did less repairs. So then more tenants moved out. So then he had even less money, and you get the point. To the point where he was 3 years behind on taxes. So that's a desperate seller, if you ask me. So we were able to work out a deal with him to buy that on land contract. As I'm sure you know, and most listeners know here, a bank is not going to finance a non-performing multifamily property like that. So we bought that land contract with we bought it for $515,000, and we put I think about $120,000 down on that. And now I was the proud new owner of a 42% occupied hunk of junk apartment building.
Now,
but it's the best deal I've ever made.
Yeah, where was this located?
We still own it today. It's in Rockwood, which is just the farthest city south in Wayne County.
Great. Well, let's wrap it up here because I think you've really given us a lot of great information about the beginning of your portfolio, buying single families, managing them yourselves. Going from 0 to 20, 24 units and getting past those plateaus along the way. And then with, one purchase, you doubled your portfolio. And that's what I want to get into next week. So Josh, thank you very much for taking the time this week to talk to us. And I can't wait to come back and talk to you again next week.
Well, thank you very much for having me. It's been great.
So before we go, I want to take a moment and talk about the Rental Property Owners Association. And if you've been listening to this podcast, you know that a lot of the guests that I've had on this show are members. And as a member myself, I can tell you that the RPOA provides a lot of value, not just to me, but to all Michigan rental property owners and real estate investors. And right now, they are offering a 50% discount on first-time memberships by calling this number, 616-454-3385. And you can call that number Monday through Friday. And if you mention this podcast, you'll get a 50% discount on a first-time membership. And once again, that number is 616-454-3385.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.